Hi guys, welcome to Trade for Learning. This is channel where we will learn how to do option trading as a business instead of just doing as a trading or gambling. So if you guys still not yet subscribed, please subscribe, like, share and go through all the videos so that you'll get to know what is all about this channel is referred to. So today's topic is in option trading. We're going to discuss about what is options, call and put. If you guys are interested in trading, you would already know that what is this trading, intraday, options trading and futures trading. So, but still you are in a mode of understanding the terminologies, how it refers, how it works and what is the terminologies that they are using. So in this video, we will discuss about what is call, what is put in option trading. So if you want to know what is option trading, you can refer the videos that is mentioned in the top right corner. If you are interested to know how can we use this options trading as a business, then you can refer this top corner videos link, or you can go to my all the videos channel inside the channel. So let's go to this options call, put terminologies and what it is. So if you are aware of market, when it comes to market, there will be only three type of trends exist. The trend is nothing but the movement of a stock or maybe index. Index is nothing but combination of all the stocks. It may be considered as an average trend. So obviously the market will go either of these three directions, either upward, downward or sideways. So today we will discuss about this call. Short term call it as CE, put, short term call it as PE. So these two things we are referring in option trading as a strike rate. So when it comes to strike rate, it's nothing but the price where we are assuming the market will end up before the expiry day or at the expiry day. Expiry day in the sense it can be weekly or monthly option that what you brought will get expired. If in case if it's expired with your predictions, according to your predictions, there will be a huge profit if you brought that option, else you will be losing the whole premium amount that you have paid. So when it comes to call or put, both of them is a separate entity that you can buy or you can sell. When it comes to call, it's completely depends on uptrend strike price, and when it comes to put, it's completely depends on downtrend strike price. I will explain detail how actually this trend strike price reacts and what it is in the next slide. So let's go to the buyer and seller perspective. When it comes to buyer, as a buyer is an insurer, seller as a insurer. Insurer means who is getting insurance by paying a premium. Seller is who is a person who is giving insurance. So these two things will play major role in call and put options. In both call and put, you can be either buyer or seller. If you buy a call or put, you have to pay a premium. If you sell a call or put, you have to pay whole margin that required to sell. Buyer need only premium amount that we explained in the previous video, and seller need full margin to sell the premium, that particular strike price. It may be call or put, and the loss will be restricted to particular premium that you paid. Seller loss may be infinite. Actually, practically there is nothing called infinite. It will be like more than this buyer's loss. So let's go to the next slide where we'll explain what is the strike price, how this call and put the terminology is used here. This is a simple slide where I'll explain Banknifty. Banknifty is nothing but a consolidated stocks which is related to banks, and it has a trend line. If you see this is a chart. I'm showing this every day chart and it has like upward or uptrend or downtrend based on the direction of the movement. Let's go back to the slide. Here if we see call and put and current market, let's see, this is the line where we are showing is a current market price. Assume that it's around 27,000. This is what actually I'm referring, the chart current rate 27,000 something. So now the strike price, which is 2700 or 27,200, those are all strike prices. It may be 27,000, 26,500, 900, 26,800. These are all strike prices. They are divided by 100 points. It will be vary from 10 points, 100 points difference. But in case of Bank Nifty, we will refer as a 100-point difference. Each one has a one entity and each has its own price. It may be like, for example, if it's too far strike price from the current price, it may be valid for 10 rupees, 20 rupees. If it's too far in a downtrend, that is also valid for a price of 20 rupees, 30 rupees. As and when the strike price is near to the current price, the cost of the particular strike price entity will increase. It may become to 100, 200 rupees. So if the option strike price that we brought, which is already crossed by the current trend, current price, then it's called in the money. The name how it says, right, in the money. It means you're part of the, already you're part of the strike price. For example, if the market is going up, you brought some 26,900 2 days before, now it's 27,000, it means you already in the money. The price what you brought is already multiplied by 200 times, 300 times, 400 times. 50 rupees become 200 rupees. Because you already crossed these assumptions. Whatever the assumption that you had on the strike price is already achieved. So the call, so in this what you understood is like call means like you are assuming that market will cross the particular price, strike price, by that expiry time, before or at that expiry time, so that you will purchase with the 50 rupees or 100 rupees, whatever the cost, and it will multiply by 200 or 300 times. So if it crosses before the expiry, then you will be in a profit. If it didn't cross the whole amount you paid with the quantity, that will be part going to seller as a premium. So similar for put, if the market is going on downtrend, for example, you brought something like the current trend was when you're purchasing, it was 27,300, but you are assuming that market will go down, so you brought put call. It was around 27,100. So now the market went down with before expiry and currently it's under 27,000. It means the strike price what you brought by assuming that market will go down, that is called put, it's already breached and still it's going down, so you are in a profit. This is called buying a call or buying a put options. So obviously when it comes to buyer, there will be equivalent sellers. So for them it's a vice versa. For example, whatever the premium that you purchased with the strike price, particular strike price, if it didn't reach, then the person who sold, he will be in profit of the premium what you paid. If it breaches that, then you will be in profit. He will be in some infinite, not infinite, like a big loss. But if you already refer the video of previous one, you would have already understood. Actually 99% or 90% of the sellers will always win, 10% of buyers always lose when it comes to a particular expiry, because the sellers who do these options are most of the times are retailers. They somehow have more experience and they can predict the market to which range it will not reach. So that's why they will sell that particular strike price. For example, if the current strike price is 27,000, they might be selling 28,000 for a week by assuming that within a week this 1,000 move will not do. In either maybe when it comes to call, either maybe upward direction, when it comes to put, lower directions. So within the 1 week, most of the times this 1,000 points jump is very rarely and very rare scenario, so they will be end up with profit. This is how actually seller gains a premium. But if a person same, obviously there will be equivalent opposite person who brought that, he will be end up with losing the premium. He will think that that premium is small, but when it comes to seller, for him it's a regular income. He will be earning those small premium and collecting them. But buyer, always a new buyer will come and do the same mistake, that will end up with losing that particular premium. If it's a near premium, obviously you will be in a chance of getting the money or doubling or 3 times 4 times, but the price of the strike price is too huge, so most probably the person who is new to this option, they will not purchase that. And if in case if it's already crossed, then the price will be like, instead of 50 rupees, it might be costing around 400 or 500 rupees. And if it slightly go down or against, then suddenly that 500 rupees become 200. So he will be losing half of the money. So most of the time buyers will not purchase in the money. They'll try to purchase a cheaper one as a latter ticket, but they will end up with losing their money. Let's go to this chart. This is the chart how it look like for every day. So this is trend. So usually the strike price, what you call for this, like 27,300 is the current price. So 28,000 is above one and 26,000 below one. So for example, if you think about like expiry is going to happen in 2 days, if you sell around 25,000 or 30,000, call and put, obviously most of the times like 99% it will not reach. So the price may be, the premium price may be 10 rupees, but the 10 rupees whatever the person who sold, he'll earn that. The probability is more. This is how actually seller will always win. So I think you guys already understood what is call and put by this video's explanation. Call or put, both are you can buy or sell. Call is meant for the strike price which is in uptrend. Put is meant for the strike price which is in low downtrend. So the strike price who brought by, it may be call or put, he will always expect market to go above that particular strike price. The seller will always want to expiry the particular week or month before, within that range, so that he will earn that premium. Now let's go to this few questions that what we understood from this slide. So what is call that you understood? What is put? This is you understood. Call is meant for the uptrend. Put is meant for low trend. Both call and put you can buy or sell. Buy you need small premium amount. Seller you need more margin. Who is buyer? Who is seller? The person who buys with a small premium is called a premium buyer. He is expecting market to go in his predicted direction. Seller is who is selling that particular premium. He might be occurring a huge loss if in case it reaches his particular targeted strike price against him. So, but the 90% seller will win, 10% buyers will win. There is nothing called buyers always lose. It's like a sudden increment, what you call price jump or something happens always. So he might be winning, but most of the times as a small premium, sellers will win. So that's why big institutions, they will go with the seller, the small premiums, that make sure that they will get the premium on expiry day, the day exactly when the expiry happens for the particular strike price, that day, or maybe whole week. And what is the time value decay and to whom it's useful? It's called theta. Actually the time value decay is usually helpful for sellers, because as and when you sell any options, call or put strike price, as and when the day by day, when it's near to the expiry day, the value of that particular strike price will reduce if in case it's too far. If it crosses the strike price, then it will obviously double or 4 times or 3 times, whatever. But if it didn't cross, and there is assumption that it will not cross because of too far, or maybe the direction is reverse or vice versa, so in that case the price will drastically change. It's like, for example, if it's 50 rupees, tomorrow if you see you brought a call, assuming that it will reach some 27,200 and today is 27,100, instead of that crossing 27,200 tomorrow, it suddenly break down the 200 point negative, it's become 26,800. Then the 50 rupees price will, in the morning, whatever that you saw in the yesterday afternoon, today morning if you see, it will be trading around only 10 rupees or 20 rupees. That is the difference, what it calls theta. So automatically when the market goes in against the buyer and the expiry is near, then automatically the value of the particular call or put who brought the value of that, it automatically decay too much fast. That will be helpful for sellers, because that's the reason why seller will do this, selling options as a call or put. Why can't we buy put instead of selling a call? So when we discussed, call is meant for the upper trend, sell is meant for put is meant for downtrend. So instead of selling a call, this is one question that I had a doubt in the beginning. Instead of selling a call, why can't you buy a put? Because put is meant for downtrend, call is meant for uptrend. Selling a call is nothing but a downtrend. So why we are not buying a put? The reason here is like the market might go down, but buying a options is nothing but you should have a clear assumption that 100% market will go in your direction and the speed of this movement will be very fast, so that at least you will be far from the strike price with the 200 points in your direction. Maybe for example you are expecting market to expect 27 above 27,000, then the current trend is very fast and it's already reached 27,200, then the strike price will increase. In that is the only case where we will buy the call. Similar for put also. So the downtrend is very fast and going steep, then you can buy the put. But why always the sellers will prefer to sell the call itself is because, for example, there is a call which is costing around 40 rupees and the put it was costing around 50 rupees. So when the market goes against him, the put call whatever it was around 50 rupees become maximum like 60 or 70, but whatever the call it was brought for 50 rupees become 10 rupees. There is a lot of theta effect, time decay value that will affect to call. That's why instead of buying a put, for those who are interested and assuming that market will go down, they will still sell the call itself. This is the difference of sellers and buyers. Hope you guys you understood from this video. If you like this video of basic strategy of what is options trading and how to make options as a business, and what is options, call options, put options, and buying and selling, please like this video, share, comment, and we'll come back with a new video with a basic and simple example, so that we'll go with the same flow that what we are going on. And the basic plan of this video is to focus on learning first, then investing, implementing the real strategy with the money. So this is what all about. So we'll focus on learning with a basic and simple example. Once we learn, then only we'll trade with the money. Thank you guys. Bye bye.